If you've been at Stryker any length of time, here's a question for you. What was your very first RSU grant worth? Maybe it was $10, $20, $30,000. Maybe it was more. Now think about that today. You've received another grant, then another and another. If you've been here for 10 or 15 years, there's a decent chance your company stock has quietly become one of the largest assets you own. And that's exactly why we're having this conversation. The biggest mistakes I see aren't investment mistakes, they're planning mistakes. Most people don't wake up one morning and decide, I'm gonna put half my net worth into one stock. It just sort of happens. Every year another grant comes, another portion vests, and life gets busy. Then one day you log in your UBS account or whatever brokerage account your assets are at, and you realize, whoa, I own a lot more Stryker stock than I realized. If that's you, this episode is for you. Let's answer one question. What decisions are you actually making every time your RSUs vest? Because that's how most people think about it. My shares vested, end of story. But that's actually only the beginning. Once those shares hit your account, Stryker has finished compensating you. Now you're simply an investor deciding whether Stryker is the best place for that money. That's a completely different decision. Here's the question I always ask clients. If Stryker had given you cash instead of stock today, would you immediately use all of that cash to buy Stryker shares? Most people pause, and that's the point. Because once the shares vest, continuing to hold them is the same investment decision as buying more. Mistake number one, never reevaluating after each vesting event. One thing that's unique about many Stryker employees is that the equity is not a one-time event. Many employees receive annual grants, and those grants vest over time. So after a few years, you've got multiple grants all vesting on different schedules. Every year, your company is effectively asking you, now that these shares belong to you, what do you want to do with them? Unfortunately, most people never answer that question. They simply hold them, not because they analyze the decision, because they never stop to make one. Mistake number two, confusing loyalty with portfolio construction. Here's something I want to be really careful about. Nothing I'm saying today is a prediction about Stryker. In fact, the reason many employees have done so well is because Stryker has been such a successful company. But your investment portfolio shouldn't be a report card on how much you love your employer. You can absolutely believe in Stryker, love working there, and plan to stay another 20 years, and still decide that owning 50 or 60% of your investments in one stock isn't the best long-term strategy. Those aren't conflicting ideas. They're two different decisions. One is about your career, the other is about your family's financial future. Here's where it gets interesting. Most people think risk means volatility. I don't. Real risk is when one event affects multiple parts of your life at the same time. Imagine something unexpected happened to Stryker. What happens? Your paycheck is affected, future RSU grants could be affected, your bonus could be affected, and if most of your investments are in Stryker stock, your portfolio could be affected big time too. That's concentration risk, not because Stryker is a bad company. In fact, I think Stryker is a very well-run company, but every company is still just one company. Mistake number three, assuming taxes are finished. Here's another misconception. I already pay taxes. Maybe, maybe not. When RSUs vest, taxes are withheld, but withholding isn't the same thing as your final tax liability, especially if you're receiving bonuses, selling investments, your spouse works, or you have multiple vesting events during that year. I've seen employees owe tens of thousands more simply because they assumed withholding meant everything is covered. That's why we like running tax projections before year end. Not because taxes are exciting, but because tax surprises usually aren't. My favorite way to think about RSUs, people often ask, so should I keep my shares or should I sell them? I think that's actually the wrong question. Instead, ask this, what percentage of my family's wealth should depend on one company? Notice how different that question feels. Now we're not talking about today's stock price. We're talking about your overall financial life. Maybe the answer is 10%, maybe it's 15%. Everyone's answer can be different. But once you have that number, every future vest becomes much more easy. Let me tell you a story about a Stryker employee who worked there about 13 years. Every time she received another grant, she never sold because the company kept doing well. When we first met, she almost had about $1.1 million in company stock. Here's the interesting part. She didn't intend for that to happen. It wasn't a strategy. It was simply the accumulation of dozens of small decisions that were never being made. Instead of selling everything overnight, we built a 5-year plan. As each new grant vested, we would evaluate whether she was above her target allocation or below it. Sometimes would sell, sometimes would hold, Sometimes we'll coordinate sales with charitable giving or other tax strategies. Nothing dramatic, just small, consistent decisions. That's usually how good financial planning works. The biggest lesson from today isn't that you should sell your RSUs, and it isn't that you should keep them. The lesson is this: every time your shares vest, you have a new decision to make. The worst answer isn't holding, it's not even selling. The worst answer is making no decision at all. In our next episode, we're gonna build on today's conversation by talking about non-qualified stock options, because unlike RSUs, stock options introduce another question. Not just should you sell, but when you should exercise. And getting that answer right can have a significant impact on your long-term wealth. Thanks for listening, and we'll see you next time.